The current state of the U.S. economy doesn't look good at all. In fact, legendary investor Michael Novogratz is explicitly warning that the economy is starting to fall apart. We are going into recession really fast, and you can see that in lots of ways, he said. Housing is starting to roll over. Inventories have exploded. There are layoffs in multiple industries, and the Fed will continue to hike interest rates until inflation rolls over. Businesses are nervous, and sentiment is at risk of breaking even if nothing goes wrong, added Mark Zandi, the chief economist at Moody's Analytics. And plenty could go wrong. A severe downturn could materialize swiftly if businesses lose faith, and there is a good chance they will. The economy is throttling back, way back, he alerts. Several indicators are pointing to more trouble ahead. What most people still don't realize is that we're facing the combined threat of a recession, tumbling stocks, crashing home prices, mass layoffs, and stubborn inflation all at once. The end game is going to be catastrophic. In today's video, we've compiled several stats that expose the dire state of the U.S. economy, as well as forecasts, projections, and warnings from some of the brightest minds in the economic and financial world. Before moving on, please support our work with a thumbs up and don't forget to subscribe. Without further ado, let's check this list. 1. In a stark reversal from the record congestion we've witnessed in the past couple of years, U.S. ports are now seeing cargo traffic decline to the lowest levels since the early days of the pandemic. That's a major sign that economic activity is stalling all around the nation. In December, the busiest port in America, the Port of Los Angeles, experienced a 26% drop in cargo volumes amid the holiday shopping season, the period when the exact opposite typically occurs. We're seeing a nationwide slowing of imports, Port of LA Executive Director Gene Soroka said during the December cargo briefing. Imports were down 24% compared with a year ago, and exports out of China fell almost 9%, the biggest drop since February of 2020 when lockdowns brought production to a crawl, Soroka revealed. We're seeing cancelled or blank sailings, he added, noting that 13 ships were cancelled last month. He anticipates 11 sailings will be cancelled in January as the economy continues to slump. 2. In November, U.S. diesel inventories have fallen to the lowest level since 2008, which prompted the Energy Information Association to warn that nationwide fuel shortages were likely to occur amid dwindling supplies. Even though government officials rapidly dismissed EIA's forecasts, saying that refiners would deploy emergency reserves soon, last week EIA reported that distillate inventories dropped more than expected, falling by 1.4 million versus expectations of a 396,000 barrel drop. That's extremely alarming, and marked the fourth consecutive month in which inventories remained below the 5-year average. Now, this is something we should watch very carefully because the whole U.S. economy runs on diesel. If we run out of enough supplies, deliveries would stop, prices would skyrocket, which consequently could make inflation even worse. 3. A poll conducted by PwC discovered that 50% of all U.S. companies have plans to eliminate jobs within the next 6 months. About 52% foresee instituting a hiring freeze, and 44% rescinding job offers. On top of that, roughly 45% of all small businesses have already decided to freeze the hiring of new workers. In the last quarter, big names including Groupon, FedEx, HBO Max, Shopify, Remax, and even Amazon have cut tens of thousands of jobs as costs keep on rising while consumers tighten their belts. it's safe to say that it won't take too long before mass layoffs start being announced again. 4. A new Alignable survey found that 41% of all small business owners in the United States could not afford to pay rent last month. Unfortunately, 41% of US-based small business owners report that they could not pay their rent in full and on time in December. That is a new record for 2022, researchers noted, adding, making matters worse, this occurred during a quarter when more money should be coming in, and rent delinquency rates should be decreasing. But so far this quarter, the opposite has been true. That is more problematic than it looks. When commercial real estate tenants cannot pay rent, that inevitably creates a domino effect. The financial problems businesses are confronting right now mean that in a few months, we might have millions of empty commercial spaces all over the nation, and landlords will soon be unable to make loan payments because sufficient rent money is not coming in. We already entered a huge commercial real estate bubble in the past few years, and rising delinquency rates, in addition to the highest interest rates in more than a decade, that could rapidly spiral to trigger a commercial real estate crash of unprecedented size and scope. A separate survey by Next Insurance found that 51% of all small business owners in the U.S. believe that rising prices could force them to close their businesses within the next 6 months. Small business owners across the United States are frustrated and stressed about inflation and the state of the economy, the group said. As prices continue to rise and supply chains continue to falter, many small business owners have been forced to work longer hours, raise prices, and even cut their own salaries just to stay afloat, our survey found. And a majority of small business owners believe the pain is not over. 6. Wholesale prices continue to accelerate at a very alarming pace. As inflationary pressures have persisted, the Bureau of Labor Statistics reported that last month, wholesale prices rose more than expected as food prices continued to surge. The Producer Price Index, that's a measure of the prices paid to producers of goods and services, rose 0.8% for the month and 10.8% over the past year. When costs are expensive at the wholesale level, shoppers should start worrying, because that will be reflected at the consumer level too. 7. With food prices jumping by 13% over the past year, staples such as vegetables going up by 80%, while eggs doubled in price, chicken and meat prices saw increases of more than 20%, and even dried, canned, and frozen goods are facing absurd price hikes. Nearly all Americans are struggling to afford groceries these days, which is leading many cash-strapped households to take out short-term loans to be able to serve food at the table. Zip, one of the biggest players in the short-term loan industry, revealed that demand for its services more than doubled over the past 12 months. And with a series of food companies such as Mondelez, Kraft Heinz, PepsiCo, Nestle, and JBS announcing double-digit price surges over the next few months, many more Americans may have to seek alternative ways to pay for their grocery bills. 8. Stagnant wages are prompting more and more people to resort to credit cards to make ends meet. At this point, a whopping 480 million credit cards are in circulation in this country. That number has shot up by nearly 15% since 2015. Data released by USA Today shows that U.S. consumers are carrying $870 billion worth of balances on their credit cards right now. About 56% of Americans that currently have credit card balances have been carrying them for more than a year. Moreover, the number of seriously delinquent credit card accounts in the U.S. has shot up to 37 million in the fourth quarter. 9. The housing market meltdown that is unfolding right now is set to result in the greatest bubble burst in all of U.S. history. The rapid rise in interest rates has already pushed home sales to a 10-year low. At the same time, mortgage demand has just plummeted to the lowest level in 25 years. According to Ian Shepardson, the chief economist at Pantheon Macroeconomics, national home prices could fall 20% in the first half of 2023. In one line, collapse in prices is coming, wrote Kieran Clancy, the firm's senior economist. Another proof that real estate companies are bracing for a crash is the fact that Blackstone has prepared a fund of $50 billion so that it can scoop up depressed real estate all over the country after housing prices have plunged in the months ahead. Things never even got this bad during the downturn of 2008 and 2009. This is a really troubling sign. 10. Total consumer debt in America, including mortgages and all other kinds of individual debt, surpassed the $16 trillion mark in September, and we're now close to $17 trillion, with economists projecting that sum to reach $20 trillion in early 2024. That's right, Americans are on track to be $20 trillion in debt. 11. Plummeting stock prices in recent months have wiped out millions of retirement accounts in the United States. The latest rout that's put U.S. equities in a bear market isn't just reducing the net worth of billionaires like Elon Musk and Jeff Bezos. It's also taking a toll on Americans' retirement savings, erasing trillions of dollars in value. The sell-off resulted in a $3.1 trillion loss from U.S. retirement accounts in 2022, according to Alicia Manel, director for the Center for Retirement Research at Boston College. By her calculations, approximately 46 million accounts have been impacted, putting many retirees in an extremely difficult position, and forcing baby boomers to delay their retirement and work longer to rebuild their lost savings. 12. Even worse. Thanks to crashing stock prices, approximately $20 trillion in household net worth, which consists almost entirely of financial assets and real estate, was wiped out last year. It's painful to get back to normal after really being in a fantasy world in 2021, said John Norris, chief economist at Oakworth Capital Bank, referring to the effect stimulus money had on the economy and financial markets. Now, it's going to feel a lot worse than people could have imagined. 13. And more chaos is expected to sweep across Wall Street this winter. In a new report titled, "The Declines for Equities Will Be Much Worse Than What Most Are Expecting," Morgan Stanley Chief Investment Officer Mike Wilson alerts that falling demand from higher interest rates and higher prices are happening just as supply is catching up to these formerly well above trend levels of consumption. That combination has already caught many companies off guard who were unable to reverse the rising costs fast enough. The result has been disappointing margins relative to expectations, and we don't think that reset is near completion. In other words, companies' weaker than expected earning results are about to get many investors by surprise. The executive revealed that many of his major clients are now selling everything and going short. This could get very ugly very quickly, Wilson wrote, saying that he expects stocks to tumble another 22% during the next sell-off. 14. Corporate CEOs and financial experts from all over the country are sounding the alarm about the ongoing downturn. In fact, a survey conducted by the Conference Board revealed that 98% of CEOs are preparing for a deep U.S. recession with material global spillover in 2023. Economist and professor emeritus at the Stern School of Business, Nouriel Roubini, warns that this is not going to be a short and shallow recession. It's going to be deep and protracted. BlackRock CEO seemingly agrees with Summers' concerns. Central bankers won't ride to the rescue when growth slows in this new regime, contrary to what investors have come to expect. They are deliberately causing recessions by over-tightening policy to try to rein in inflation, he said. Meanwhile, Goldman Sachs CEO David Solomon stresses that economic growth is slowing. When I talk to our clients, they sound extremely cautious, Solomon exposed. Those are just a few of the warnings shared by executives, economists, and financial analysts recently. As conditions steadily decline, pessimism is starting to become the norm. And 15. Even the 4 biggest American banks are now getting ready for shrinking profits, Reuters reported. U.S. banking giants are forecast to report lower fourth-quarter profits this week as lenders stockpile rainy day funds to prepare for an economic slowdown that is battering investment banking, the outlets highlighted. J.P. Morgan, Bank of America, Citigroup, and Wells Fargo, along with Morgan Stanley and Goldman Sachs, are the 6 largest lenders, expected to amass a combined $5.7 billion in reserves to prepare for soured loans. That is more than double the $2.37 billion set aside a year earlier. With most U.S. economists forecasting either a significant recession this year, banks will likely incorporate a more severe economic outlook, said Morgan Stanley analysts led by Betsy Grace in a note. The 6 banks are also expected to report an average 17% drop in net profit in the fourth quarter from a year earlier, according to preliminary analyst estimates from Refinitiv. What even the largest banking institutions in the country are facing financial losses, then we know something really wrong is happening in our economy. The crisis we're about to face will be like no other. Many experts believe that the recession is staring us in the face will be even worse than what we went through more than a decade ago. This one is going to be even bigger because the economy has a lot more debt now than it did in 2008, explains economist Peter Schiff. And Americans are less able to pay it when interest rates rise because the balances are much greater. So we're in much worse shape as a result of all the bailouts and all the stimulus that papered over the last crisis. Now, the one we're dealing with is going to be much worse because we kicked the can down the road instead of solving the problem when we had a chance, he stresses. It is crystal clear now that the ripple effect of decades of reckless monetary decisions made by our leaders is now catching up with us, and the next chapters of this collapse will be even darker than the ones before. Our entire economy is crumbling down, and we're all at risk of going down with it.